the question I want to ask you now is that, central bankers move like teenagers, so to speak, in packs.
Okay. Yeah.
You understand, during that age.
Yes.
So we've seen central bankers now across the world. They are moving like teenagers, with just your explanation now. So is it also as a result that other central banks in Africa, Kenya, South Africa, Ghana is suffering an inflation of 54% or thereabout.
Yes.
So is it also because that central bankers are moving in packs like teenagers? The CBN's MPC is also saying, I think we should also tighten, because even the Fed has given that forward guidance that there would be hikes, even though inflation is coming down. I think it's at 6.5% now, so in the United States. Yes. So respond to that.
Yeah. Like I said, the economy of Nigeria is influenced by a lot of global developments. There's integration, and this integration is even stronger in the financial side. The international financial market, the banking system, relating to the exchange rate and other, investments that you see in terms of portfolio, capital flow, capital inflows, outflow, and inflows. Now, for as long as other countries that you trade with are tightening, for example, the United States, when the United States was tightening, there was a lot of capital outflow from emerging market economies, because return on investment in the United States is a lot higher. Don't forget that the risk premium there is also a lot lower. We could have higher return, but if you discount it with the risk premium, change of policy or any shock from your domestic economy, your fiscal borrowing or vulnerability in those sectors, the probability of paying back those investments, if you build it in, even if you have higher interest rate, they will still prefer to go to more stable economies that your prediction is more or less like 100% certain to move to that economy. So we saw from emerging, even though we don't have much of that in Nigeria, because a lot of those capital went out during the COVID period. So post-COVID, there was no much that would go out except those that really want to stay. So we saw that carry trade. We saw all of the economies also tightening to keep what they have and even attract the ones that are lost out from other economies. So that school behavior, that teenage, syndrome that you see everybody going the same time, is to protect your own economy space, to be more competitive, even if you don't get inflows. You don't lose a substantial part of what, because there's also the negative real interest rate also playing out there. So you need to also keep that space to hold, because all these economies need foreign investment.
So the question will be the race to who will keep investors more.
Yes, that is the competition.
Is it the ECB or the BOE or the US Fed?
Yes, so, or is it the
Nigerian Central Bank?
Yes.
Or South Africa?
Yes.
SARB?
So even we within our space, emerging market, developing economy, we're struggling for that space from funds that will come from the advanced economies or those that will go to the advanced economies. The global space too, United States, UK, Europe, they're also playing their own game to retain those investments within their economy, because it's also other source of financing or investment that are required that your domestic economies cannot meet. So you need that to even stay, because huge capital outflows impact on your exchange rate. You start seeing depreciation, and if you can't control that, you devalue. If you are devaluing, it feeds into your domestic prices, because you're also import dependent. You're also we have exposures in foreign assets. You're borrowing, the federal government is borrowing, the states are borrowing, the banks of Nigerian banks are also exposed to foreign credit. So when your currency depreciates or you devalue, all those affect the cost of servicing debt for government, increases substantially. The ability of these banks or investors, the domestic that have taken foreign assets, loans, is also impacted. Their credit worthiness or the credit default risk heightens when those rates go up. So you have those bucket of the economy to also look at. So yes, it is a bandwagon effect. Everybody is doing it, but you do it based on the characteristics of your own economy and how you think those developments will impact on you. When we do monetary policy analysis, we do what we call an appraisal of the global economy and the implications of those global development on the domestic economy. And it's based on that you take your own decision.